Hello everyone. I hope you are doing good, mentally and physically fit and fine. Friends, so we are already through with six chapters in six lectures. We are through with the six chapters, and today we target around 45 questions. Around 45 questions we are going to cover in 2 hours because many of those questions are pretty simple, straightforward. Some of them are really very interesting. And we are going to finish off chapter number 7 here today. And then tomorrow's lectures are going to be, next lectures are going to be very, very important, where we cover 800 series, 4000, 3000 series, and so on. Okay, guys, let's start with chapter number 7. We have already seen few questions of SA 701. Let me remind you about 701 few things because we are going to need them today. So this was the last question we saw. Last very interesting question we saw, guys. Come on. Now let's see more questions. So it's a question. Don't go and read the title of the question. That's very good for the revision purpose. That's very good for revision purpose, but it's not good if you simply go and read the go and read the crux before going through Q&A, understanding its depth, the way of drafting, and so on. So those things are extremely important. Let's see. One hour. So here they're saying that a draft audit report is prepared. And in that draft audit report, there are two paragraphs, paragraph A and paragraph B. The two paragraph A and B. In paragraph A, they explain, they talk about revenue recognition. They talk about revenue recognition. And they say that revenue recognition is done as per contract, but then so there's a sales contract arrangement, and a lot of judgment is required. A lot of judgment is required to recognize the sale. A lot of judgment is required. Okay, so that's the story in paragraph A. So this is paragraph A, friends. And then we have paragraph B, there they explain what they did about this particular revenue recognition. They read revenue recognition policy, they assessed the internal control systems, they tested a revenue on sample basis. So they're explaining that revenue recognition is having an issue, and that is a lot of complexity and a lot of judgment is required. That's the issue, and how they're tackling it. The question is, these two paragraphs belongs to, so these two paragraphs, the exact question is, under what heading such matters should go? That is the question. So basically in paragraph A, they're explaining what's the matter. They're explaining what's the matter, and then next they're explaining how it is addressed. Okay. And then they're saying, let us know where these paragraphs should be placed in the audit report. Where it should be placed. Just a minute, guys. Now, where it should be placed? Very interesting one. Now, if you have solved this question before, you will be able to identify it quickly. But then that's what we're trying. We're trying to understand how to interpret the questions. how to interpret the question, how to interpret the questions. That's the whole game. So this should go in key audit matter. So this is a complicated issue. This is a judgment based issue, and here it is addressed. That's what goes in a key audit matter. In key audit matter, first to explain the matter, point number one, you generally give reference to notes to accounts from where you can get more details about the matter. Then you explain how you have addressed the matter. You also explain why this matter was considered key audit matter. Generally, there are three reasons for any matter to become key audit matter. First, because of significant risk, high risk of material misstatement, because of risk it can be there, or because there is a significant management judgment. There's a very big judgment which management has made and we are supposed to go and evaluate it. And third is significant events and transactions. So here you will have to identify, okay, these paragraphs should go in key audit matters section. So it's pretty simple, guys. What you can do is you can explain SS 701. You can simply explain SA 701, give reference, explain, define key audit matter, define key audit matter. You can also explain how it is determined. So the way we explain our notes, there are 4-step process to determine a key audit matter. You get the list of matter, communicated to TCWG. Out of that, you identify matter which generally need significant attention. So there are three such matters. Three such matters are there which need significant auditor's attention. Matter number 1, 2, 3. Significant auditor attention is required. Significant auditor attention is required. Where is it required, guys? Okay, where there's a significant risk or high risk of material misstatement. Significant risk or high risk of material misstatement. Okay. Then, where we are supposed to evaluate significant management judgments, and last is again significant transactions and events. Out of that, we identify items of most significance. Items of most significance, and then it should belong to current year. How it is determined? Then you discuss the case. Then you discuss this particular case. Okay, that okay, such kind of 2 paragraphs are given, and then you say the conclusion that revenue recognition is a key audit matter because of significant management judgment is required. It will need a lot of auditors' attention. It will become key audit matter. Okay, so I will say that yeah, it is uniquely drafted question. Yeah, it is uniquely drafted, a different way altogether. It's a lovely question, guys. Guys, as I said, I expect you to share our content, our books, our videos to all your friends and all your colleagues, whoever you know, your juniors, and do put your lovely comments in the video once you're through with the video. Those things really, we really love those things. We are really happy for those things. Okay, guys. Now, next is reporting key audit matter. Reporting key audit. Okay. Next is very interesting. Very, very interesting. So, There is definite plan to close the business. There's definite plan to close the business, and they say that within short period we are going to close. So management decided to close the business, and then they say that within short period they are going to close this business. Now it is not defined what is the short period. Is it 12 months or more than 12 months? We don't know that. They're simply saying short period from the close of the accounting year. But even though management has decided that, they continue to prepare their financial statement on the same basis as they have prepared in the previous year. They are following going concern. They are following going concern and doing accounting as per that only. So they are following historical cost concept. But what they have done is they have given additional note that the business of the company shall cease in near future and the assets shall be disposed of in accordance with the planned disposal of the management. The statutory auditor of the company indicated this in key audit matter. So what statutory auditor did, they explained this in key audit matter only by reference to possible cessation of the business and making adjustments, if any, thereto at the time of cessation only. So they went to key audit matter, and there they explained that okay, business will be closed in near future, and adjustments will be done whenever business will be sold, whenever they cease to do business. So whether such kind of reporting is appropriate. Okay. Now listen, guys. In this scenario, the two interpretations are possible. I'm not very happy with the way Institute has answered it. Two scenarios are very much possible. First of all, you say that, okay, these guys decided to close the business. So close the business. So whenever they decide to close the business, there arises significant doubt or going concern whether they will be able to continue for next 12 months or not. Because business can be closed over the period of 2 years, 3 years, 4 years, 5 years, depending on size and nature of the business, because you have to recover money from the debtors, you have to sell your inventory, and a lot of things need to be done. You need a proper buyer, then only you close it or sell it, dispose it. So now if they are saying that it will be done within the short time, within 12 months. So they have decided it, that creates doubt or going concern, it can lead to material uncertainty. And the next thing is, they say that it will be done within short period, within 12 months. So taking these two information that they have decided to close and that too within 12 months, we can say that they are not going to continue for foreseeable future. They won't be continuing for foreseeable future. So we'll say that going concern is invalid. Going concern is invalid. Now going concern is invalid, but they are not doing anything about it. They are not doing any adjustment. They're not going to any disclosure as such like that. That's really wrong. We directly go for the adverse opinion. In this situation, we directly go for adverse. We directly go for the adverse opinion in this particular situation, guys. Okay, that is scenario number 1. Now, that is scenario number 1. Now the next situation which is possible. We say that okay, they have decided to close the business, but we don't know what is short term. It can be 2 years, 3 years. It can be like that. It may take a lot of time. Again, to hunt for the buyer, and it's a long process. So it will take more than 12 months. So we'll say that yes, there is definitely material uncertainty. Now going concern depends on happening or non-happening of future events whenever we get the buyer and so on. There's a material uncertainty involved. Right now there's a material uncertainty, and when it comes to there is material uncertainty involved, and because there is a material uncertainty, we should introduce MUGC. We should introduce MUGC section in our audit report, So we should have MUGC, and we should have MUGC section, MUGC, material uncertainty over going concern, MUGC section in our audit report. Okay. And in key audit matter, we have already discussed it in the last lecture, that going concern, material uncertainty or going concern is by default a key audit matter. A lot of efforts need to be given. So we'll write in key audit matter that it is a key audit matter, and for details go and read MUGC. So basically we had two options. Either to go for going concern invalid and adverse opinion, or we go for material uncertainty and then we go for MUGC and give a reference to key audit matter. Either of them. Okay. And most likely I would be supporting scenario 1. Most likely I'll be taking scenario 1, but ICI has taken scenario 2, guys. They said that, okay, let's treat it as material uncertainty only. So they have gone for second one, but further, the treatment they have given is not appropriate. They simply say that, okay, you need to give details in key audit matter, but that's not the case. You have to give details in MUGC, and in key audit matter, you're supposed to write, yes, it is a, and there's an ambiguity also, the way they explain. It is a key audit matter. Going concern, material uncertainty or going concern is a key audit matter. And for more details, you read MUGC section. So that is what they should have done. Okay. So let's freeze, guys. Let's freeze the question. So let's understand the crux of the question. The crux of the question is they are planning to close down. Okay. They are planning to close down their business. And another big question is, they have just given some details in their notes to accounts. And the big question is how to report in this situation. So one, you assume it's invalid, going concern is invalid, and you give adverse opinion. One, okay, there's a material uncertainty, go for MUGC, and key audit matter, you simply give a one-line reference. I think 1 or 2, if we want to go with the institute, scenario 2 can be there, but properly 2 sections will go. In one, you will explain uncertainty. In another, you will simply give a reference. Okay. So you can refer a rectified second situation maybe and write appropriate assumption that we are assuming short term means we expect more than 12 months will be required to close on the business. Write appropriate assumption. You can go for scenario 1 also. Okay, but write appropriate assumption. Or you can do one more thing. You can explain one and give the other as an alternative. Give the other as an alternative. So I will say that take some assumption, explain either 1 or 2 as you feel comfortable. If you are very institute pro, which let's be very close to institute, go with the scenario 2. And then as an alternative, you give scenario 1 also. I hope it is pretty clear. So it was an interesting case, very interesting case. We understood the crux. Of the question, and then we understood the crux of the answer also. Now, let's understand this, guys. So there's a listed company out here. So there's a listed company. And it is preparing consolidated financial statements. And these consolidated financial statements are materially misstated. Consolidated financial statements are materially misstated. And what's the issue with this? Why it is materially misstated? Because one of the subsidiary is not consolidated. So lot of things, fixed assets, investment, current assets, current liability, income, expense, a lot of items are getting affected. So definitely it is pervasive, material and pervasive. Further, so there is definitely material and pervasive. There is a material misstatement. There is a material misstatement, and it is pervasive. It is spread across the financial statements. Okay, but the issue is it's not practical. It's not possible to. It's not practical to quantify. There is a material misstatement, not practical. It is not practical to quantify the impact. Okay, that what will the impact across the financial statement? It's very difficult. It's not practical. That's, see, if it's practical, we give the quantitative detail. We quantify. When we modify opinion, we quantify what thing is wrong by how much amount. And if it is not practical, we simply write it is not practical to quantify it. Decided to give adverse opinion also. So it's already decided adverse opinion will be given. Key audit matter, no. Okay, the interesting part is there is no other key audit matter apart from this matter. Very beautiful thing, we discussed this. A matter may get qualified for modification also and key audit matter also. Suppose now this, if auditor has worked really hard on this matter, it is eligible for key audit matter. But then at the same time, it's a matter of modification. So it's eligible for matter of modification and matter of key audit matter also. Where will it go? Who will win? We studied this in last lecture, that modification will win over key audit matter and going concern will win over key audit matter. On the other hand, key audit matter is going to win over EMP and OMP. So it will go in the basis, it will go in basis of modification. It is going to go into basis of adverse, and in key audit matter we are going to write, except for the matter which is explained in the basis of adverse, there is no other key audit matter. There is no other key audit matter. Okay. So you explain in this particular situation, I think you explain as a 705, which will be used for modification. You explain that when we go for adverse opinion, and then when do we go for adverse opinion? We go for as a 705. When we go for adverse opinion, it should be material, it should be material misstatement, it should be pervasive. If two things are there, then we go for adverse opinion. Explain that. We explain this in basis of adverse opinion. Then you explain SA 701. Then you explain SA 701. You explain what is key audit matter. You explain that if matter is a matter of modification, it will go to basis para and not key audit matter. This is what is there. We'll explain and we'll refer it. A reference will be given, and if there is no key audit matter, we explain there is no key audit matter. Then we finally discuss the case. And conclusion, we draft key audit matter. In conclusion, we draft key audit matter. So we will simply go and draft this. Except for the matter described in basis for adverse, we have determined that there is no key audit matter to communicate. So basically, so Basically, you need to explain SS 705 also, explain 701 also, and then you say that, okay, that's what I'm going to write in key audit matter. That apart from the matter which is explained in basis of adverse, there is no other key audit matter. Okay. So that was a lovely question, guys. That was a lovely question. And now, so beautiful questions are there, and there's lots to understand, explore, and upgrade our knowledge, and improve our question understanding skills, and then go for the answer, the way we draft the answers, and so on. Now, next one is, what is auditor's responsibility to report? What is the auditor's responsibility to report a key audit matter for which there are no relevant disclosures in the financial statements? What is auditor's responsibility to report a key audit matter for which there are no relevant disclosures in financial statement? No relevant disclosures in financial statements. Let's understand this, guys. When it comes to key audit matter, in this particular section, we are supposed to explain what's the matter, then we are supposed to give reference, reference to note. Okay. Reference, that we explain what is the matter. If you want to understand more, we give reference to the note. Then we explain how we addressed it, so audit procedures which were performed, and we also explain the reason, whether it is because of risk, it is considered key audit matter, whether it is because of judgment, it is considered key audit matter, or is it because of significant transaction is considered key audit matter. So this is the point that we generally give reference. What they're saying is, management has not given any note. Management has not given any note in notes to accounts. There is nothing for which we can give reference. So what auditor should do in this situation? So let me understand, guys. We are supposed to focus on 2 points. Point 1, point 2. First, you're supposed to explain, okay, so whenever we give key audit matter, we generally give reference to the notes to accounts, which people can go and read for more understanding. Then we say that even if there is no corresponding note in notes to accounts, then also we are going to put key audit matter. So sometimes there will be a key audit matter without any reference to notes to accounts. That's point number 1. So they give example that supposedly this year company changed their accounting software. They changed their accounting software. There is a shift, and a lot of efforts were required to understand it, to check it, whether everything is all right. So it was a key audit matter. But management has not given any reference in notes to account about change in accounting software, because it is not required as per AS or Ind AS. So still we are going to put a key audit matter. So key audit matter will be always there, irrespective of whether we are having a note to be referred or not. That's point number 1. Then point number 2, you explain that suppose a note is required for more and better understanding of the users of the audit report. It should have been there. In such case, auditor should sit with the applicable financial reporting framework and understand whether any such disclosure, any such kind of disclosure is required as per applicable financial reporting framework. If it is required and still not doing it, that's a non-compliance of applicable framework, and we will have to modify our opinion for this. Okay. So you explain that key audit matter will always go, and will carefully evaluate whether this disclosure is required as per applicable framework. If it is required, we are going to request management to do it. Otherwise, we'll have to modify the opinion. So they are saying go for key audit matter, and then if required by framework, ask management to do it. Okay. The last thing is little extra that was not required, is not relevant. They're explaining that sometimes we have key audit matter, still we don't disclose it, because it is prohibited by law, or uh, uh, adverse impact will be more than the public interest. So sometimes we don't do that. That's the extra portion that was not at all required. Not required at all. Now the same question can be made into form of a case study and can be asked to you. So whenever you get questions, they are not case study oriented. Don't think they're not going to come. They may come, they will just make this question into a case study and ask it. So you should understand the core principle, the core concept. Once you understand that, you will be able to solve any such kind of questions or anything which is based on this knowledge. Now next is very simple, guys. What about placement of key audit matter? Where it should be placed? Where it should be placed? So if you, it's pretty simple. It comes below going concern section. It comes below. If we are having MUGC, if we are having MUGC, material under going concern, it will come below MUGC. If not, it will come below basis of opinion. Basis of opinion. Further, when it comes to EMP and key audit matter can be below EMP or above EMP. That completely depends on relative significance, that what is more important. Suppose there is a EMP about COVID effect, it is more important, it will come before key audit matter. And we have a key audit matter on amalgamation, it may come before EMP. So position, there are three things which are explained in the position. If there is a MUGC, what will happen? If it's not, what will happen? And relative significance. So three things will be there, guys. We need to explain these three things. Sometimes below basis of opinion, sometimes below going concerns, and EMP depends, whatever is more important. So guys, we are through with beautiful SS701. We are through with lovely, beautiful SS701. We are going through, I understand, guys, we are going through important questions only. I would like to tell one more thing. We have one more channel, English lectures by Ravi Taori. You're going to find less subscribers there. You go there. We have put Q&A discussion. We have put Q&A discussion of from today. It must be around a year back. We have put Param question bank discussion. We have put Param question bank discussion, guys. So you can see those videos also. So some of the questions, if time permits, if some of the questions are not covered here, some of the questions are not covered in this particular important list, it can be covered in a previous important list. So you can get, or you can get video there also. Okay. Now, let's see this. So the first question is pretty simple, straightforward. Let's not think much about it. It's very, very simple. Simply they make up a case and then they ask us to explain types of modification. Types of modification. Simply explain what are the types of modification, and so on. So it's a pretty simple, straightforward. Give reference. give reference of SS705, give that there are two reasons for modification. If we go to audit and we are unable to obtain sufficient appropriate audit evidence, or if there's a material misstatement, those are the two reasons for modification. Then you explain three types of modified opinion or modification. When we go for qualified opinion, when we go for adverse opinion, and when we go for disclaimer, and when we go for disclaimer of opinion. So guys, qualified we know, if if the matters are material and not pervasive, matters are material and not pervasive, lack of evidence is material but not pervasive, material misstatement is material but not pervasive, we go for qualified. If material misstatements are pervasive, we go for adverse. If lack of sufficient appropriate evidence is material plus pervasive, we go for disclaimer. Simply explain that and you are through. We have given a chart also for that. It's very simple, straightforward. Then special consideration for various opinion. Special consideration means what different we will do in here. What different will you do when we talk about different? When what different will you do in your audit report when it's qualified opinion or adverse opinion or disclaimer? What special thing you are going to do? The auditor modifies the audit opinion. The auditor shall see. They are discussing that. When we modify, we change the heading of the opinion section. Apart from that, what else you are going to do? What changes you are going to bring? The biggest change is going to be in the wordings. And that's what they've explained. How will be the wordings of qualified opinion? How will the wordings of adverse and disclaimer? Now, the person who has done this question before read it carefully and then he understood, okay, here it means special considerations, means special consideration with respect to audit report. And they specifically want what changes will happen in the wordings. Okay, so that's the time interpretation skills will improve, understanding will improve, interpretation skills will improve. So you are going to explain that definitely there is going to be impact on the opinion section. You give reference of SS705, you explain there will be impact. First of all, heading is going to change, qualified opinion, adverse opinion, disclaimer of opinion. First line is going to change. In case of disclaimer, we are going to write, we were engaged to perform audit. We are going to write this, we were engaged to perform audit, we are appointed to perform audit. We cannot say we have performed audit because it's a disclaimer. And then they are going to explain the wordings for qualified, adverse and disclaimer. So in qualified, you are going to write, to the best of the information explanation, we want to say that except for the matter which is explained in basis, of qualified opinion, we say that financial statements are as per applicable financial reporting framework, whatever it is, fair presentation framework or compliance framework. And in case of fair presentation framework, we also specify whether financial statements give true and fair view. We take one more extra step in case of fair presentation framework. So here I'm going to explain these wordings for qualified. Then adverse, and what they have done is they have shown separate wordings, separate presentation for if separate presentation. They have given separate presentation. For what they have given separate presentation? They have given separate presentation, guys, for compliance framework and fair presentation framework. That's how it is done in the bare standards and auditing also. In adverse, we are going to say that because of significance of the matter which are explained in the basis for adverse, we say that financial statement they are not as per applicable framework, that doesn't give true and fair view. When it comes to disclaimer, we are going to say, okay, because of significance of the because of possible effect of the matter, because of possible effect of the matter which is explained, possible effect of the matter which is explained the basis for disclaimer, we say that we are not able to form opinion on financial statements. So see here, guys, they're explaining wordings. First, they explain wording for qualification. What if it is a fair presentation framework? What is it is a fair presentation framework? What if it is a compliance framework? We explain them. And first, they've explained from the point of view of material misstatement. Then they explain from the point of inability to obtain sufficient appropriate audit evidence. So explain the wordings you cannot write as it is. Explain the wordings. There are two types of frameworks for material misstatement and unable to obtain sufficient appropriate audit evidence. Whenever there is a lack of evidence, we simply use the word, whenever there is a lack of evidence, okay guys, we simply use the word possible effect, because possible effect of the matter, possible, because there is lack of evidence, we don't know whether things are wrong, right, whatever it is. In case of adverse, because of significance of so and so, we explain we are not able to give financial statement as not as per applicable framework, they don't give true and fair view. Again, from the point of view of fair presentation compliance framework. When it comes to disclaimer, we didn't obtain sufficient appropriate audit evidence, we are not able to form opinion, we are not giving any opinion. And first line, definitely, we say that we were engaged to perform audit. So they are saying, so this is very important to understand what they are asking for. This question can be twisted in a case study form. You should be aware about the content. You should be aware about the content, guys. So it's pretty simple, straightforward. They're explaining what's the impact. So you simply explain the impact on the title, on the first line, and then the overall wordings, how they are different in qualification, and then adverse, and then disclaimer. Now, what is the impact of disclaimer on auditor responsibility when auditor disclaims an opinion? What is the impact on about the auditor responsibility? Generally auditor has auditor responsibility has three sections. One is the objective section, then next is the scope section. Objective section is there, you explain what is the overall objective. Then there's a scope section, we explain the process, how audit is done. And then the communication section. So generally, in auditor responsibility, we go for three things. We explain objective, we explain scope, how we did our audit, what we checked, how we checked. We also explain that we communicated everything. With management TCWG, we never kept anything hidden, so that they cannot take action against us later on. We'll be having enough proof, evidences that they were aware about everything. Everything was done in consultation with the consultation. Now, what will happen? Disclaimer. There will be a statement the audit team was independent and ethical, and it was our responsibility to prepare financial statement as per to prepare to do audit as per standards on auditing. So we are ethical and independent people. We were supposed to perform audit as per standards on auditing, as per standards on auditing. But because of the matters which are explained in basis paragraph, we are not able to obtain sufficient appropriate audit evidence, and we are not able to frame opinion. So simple, explain three things: that we are independent, ethical, we are supposed to follow standards, but then because of so and so, we were not able to do it. Okay, guys, just give me a minute. This is a lovely concept of limitation of scope. Okay, guys, we are back now. There's a very simple question on limitation on scope. Limitation on scope. Limitations means restriction. Scope means what we check and how we check. So limitation on scope means there's a restriction on what we check and how we check. What to do? What to do if management is putting restrictions over the auditor? If after appointment, if they're putting restriction, what should be done? So guys, let me tell you, they're going to build a beautiful case, and that's going to be the heart of the answer. So they're going to say, auditor is not supposed to do this, not supposed to do that. Now, what as auditor will you do in this scenario, in this situation? And then you'll explain that is limitation of scope. These are we should move ahead. So let's see, concept 705.060. So we are supposed to explain this particular concept. The first thing we're supposed to explain is this. Sometimes it happens that after we accept the audit, management may come and then they say that they put restriction on scope, they put limitation on scope. Management may impose. So what we are going to do? So first point is with respect to management, we go to management and ask them, please remove restrictions, please remove limitations. It's a request. We are not able to do audit as required by standards on auditing. Please do it. If they refuse it, if management refuse it, we start doing two things. First, we will go to TCWG and ask them that please remove these restrictions. Please remove these restrictions. And the next thing is we start performing alternative audit procedures, guys. We start performing alternative audit procedures. So we start doing these two things. Once we start doing two things, now, if still we are unable to obtain sufficient appropriate audit evidence, we went to TCWG, asked them to rectify things. We went for alternative audit procedures, and if still we are not able to, if we are not able to obtain sufficient and appropriate audit evidence, there's a problem with the evidence, okay, then in this particular scenario, we have to see whether it is material, we have to see, is it pervasive? If it's not pervasive, we directly go and qualify the opinion that because of this we were not able to audit evidence and about the material items where it is not pervasive, we are qualifying our opinion. Simply go for qualification. But if it is pervasive, that's a big issue. Two things can happen. We can either go for withdrawal or disclosure. If it's at the initial stages, then we may go for withdrawal. If it is at the later stage, we may go for disclaimer. If we are planning to go for withdrawal, we are supposed to explain TCWG that why we are withdrawing, why we are resigning, what are the reasons. To explain them and explain all the misstatements which we know till date. Till now, whatever misstatements we know, we are going to explain it to them. So first you discuss that you go to management, and what if management says no? Okay. Then then you discuss that if no one can help, then what? So we will first explain how we go to management. Then if they say no, we start doing two things. What if there is still we are having the problem? Okay. And then finally, if we plan to withdraw, so this is divided into three parts, guys. So if you remember the flow, one by one, even that will be sufficient. You go to management, they say no, we go for two things, still we don't get evidence. We see is it pervasive, and if it's not, we go for qualification. If it is, we have two options, and when to go for what. And when you plan to withdraw, you need to communicate to people why you are withdrawing. So if you have this flow in mind, guys, as I said, you'll be getting a tricky question on the same concept. Just the thing is, it's going to be in case study format. You'll be able to, you are supposed to identify which particular concepts need to be applied out there. Now, so now this very repetitive thing is going to happen now. Draft the disclaimer of opinion. Disclaimer of opinion. But then they have not written it there, guys. Again, if you read the title heading, you feel that, oh, it is so simple, but that's good for revision. For first time, you're supposed to read questions on your own. So they explain that. There's a debtor, 240 crores, no balance confirmation. So that is lack of evidence, no sufficient appropriate audit evidence. Then they are not making proper provision for doubtful debts. So there is a material misstatement also. They are making provision only for those debtors which are due older than 39 months, that is 3 years, 3 months. But this approach is not correct. It is too late. Even before that, you should start making provision for doubtful debts. So there is a big issue of lack of evidence, and there is a big issue of material misstatement also. Then there is an inventory which constitutes 38% of total assets, and no physical verification was done, no proper records are there. What should be done? What kind of opinion should be given? So from two things we are able to understand that, okay, they are talking about lack of evidence, no sufficient appropriate audit evidence. No sufficient appropriate audit evidence. Then next depends whether to qualify or go for disclaimer. That depends whether things are pervasive or not. So now, what do you mean by pervasive? If anything which affect many items, that is pervasive. That is pervasive. If you affect only one item, but that's a major portion of the financial statement, it is again pervasive. Or it's affecting notes to account, which is fundamental for understanding. It is pervasive. So three ways things will become pervasive. Now here they are giving clear hint that inventory accounts for 38% of the total asset. That's a major portion. They're clearly indicating a very big thing is going wrong here. Very big thing, you're not getting evidence. So we have to go for disclaimer. It is material and pervasive both. We have to go for disclaimer of opinion. First, you discuss concept of SS706, and then there's a case discussion out there. Then they explain disclaimer of opinion and basis. Disclaimer of opinion that because of significance of the matter which are explained the basis of disclaimer of opinion, we were not able to obtain sufficient appropriate evidence, hence we are not giving opinion on financial statements. Okay, so you're supposed to talk about disclaimer of opinion. Then the basis of disclaimer of opinion, you explain that there's a problem with debtors 240 crores, no evidence. Inventory, no evidence about existence, about the records, about the valuation. So because of these two things, we are going for disclaimer. So first explain about debtor. First paragraph, they explain about debtor. Next, they explain about inventory. Okay, very simple, straightforward, guys. So now here, it's a repetition, guys. It's a pure repetition. Similar kind of case we have seen just now. We saw this in I think it was 112.325 or 350. We started something very close to this. 112.350. Not exactly, but similar. So, not this one. Just a minute. Okay, this one. This is similar to 112.350. So guys, it's very similar to 112.350. A very similar thing is there that controlling interest was acquired. If controlling interest is acquired, then it becomes the subsidiary. It becomes the subsidiary. It should be consolidated, but no consolidation was done. No consolidation was done. You're not consolidating. It's a material misstatement. It is a material. You're not consolidating. It's a material misstatement. Okay, there's a material misstatement and it's all pervasive, and because of that we'll have to go for the adverse opinion. Because of that we're supposed to go for adverse opinion. Okay, this is the what the tune this is what is question asks for. Okay, so 112.350 was on it was also talking about key audit matter. So here it's not talking about key audit, it's purely talking about the adverse thing. It is purely talking about the adverse thing. It is not talking about other things. It is not talking about key audit matter, etc. But it's very similar to that one. Again, it's a repetition. Again, they are focusing that they're unable to obtain sufficient appropriate audit evidence of an element which is 90% of the group's net assets. So we understand that matter is hitting only one item, but it is a major portion of the financial statement. 91% of the net assets. So it will be considered pervasive. It will be considered pervasive. So we'll have to give disclaimer. Unable to obtain sufficient appropriate audit evidence and it's material and pervasive, we go for disclaimer. So we'll have to go explain disclaimer of opinion. It's pretty simple, straightforward. Disclaimer. And why disclaimer? Because it's a very big contributor. It's pervasive. Guys, now this is very simple, very simple, straightforward theory. Very simple, straightforward theory. In fact, a preliminary theory. So why you have taken it is an important? I have taken it as an important because that is there in the module. They are going to twist it and draft a case study on this. So you should have an overview. They may not ask the concept in the same manner, but they may ask in twisted manner. So you should be aware about these concepts, guys. Just a minute, guys. Give me a minute. Give me a minute. Okay, guys, let's see. So, question is about reporting to shareholders, versus reporting to TCWG. It's pretty simple, straightforward, guys. So when we talk about reporting to shareholders, so as per section 143, auditors are supposed to make audit report for shareholders, and this report is prepared as per format given in SS 700. So both of them, they talk about reporting to shareholders. Okay. And the most important thing what we write in the report is true and fair view, and it is a public document. When you talk about reporting TCWG, this communication is done as per requirement of SA 260. There are variety of the matters which need to be communicated. Just after appointment, we need to communicate about responsibility. Then we need to give overview of the plan, significant findings, anything which affects audit report, and so on. And this communication is private. It's confidential. It is not shared with the public. Okay, so this was the difference between reporting to shareholders, and reporting to TCWG. Now, very pretty simple. What is different between audit qualification and emphasis of matter paragraph? If we feel that we are unable to obtain sufficient appropriate audit evidence, or there is a material misstatement which is material but not pervasive, we go for qualification. If we think that there is a matter in the financial statement which should be highlighted, or attention should be drawn to it, so that understanding of the people with respect to financial statement improves, and it is not modifying our opinion. So one about the matters affecting opinion, and one is simply is not affecting opinion. We want to highlight something for better understanding, not affecting the opinion. It is governed by 706, it's governed by 705 and 706. Two are different. So concept is different, standards are different, the way they are presented and where they are presented in audit report, even that is different. Both are different concepts altogether. The only thing which is common is that it is given in audit report. That's it. Nothing else, guys. It is just given in the audit report. Now, so there's a case study out here that financial arrangements, loans are getting expired. We are supposed to repay. But the company is, and further company is not able to renegotiate or obtain replacement financing. So the problem is that we are supposed to repay, but we are not getting renegotiation or replacement finance. That's a problem. And it is explained in notes to accounts. Notes to accounts simply explain it, but it is not having full disclosure. There is no proper disclosure. What kind of opinion should be given? So, guys, there are financial issues, financial matters. These matters create significant doubt or going concern. Basically, it is a material uncertainty. There's a big material uncertainty. Going concern depends on happening or non happening of future events. There's a material uncertainty. And there's no adequate disclosure in notes to account. If there's no adequate disclosure in notes to accounts, we may go for qualify or we may go for adverse, depending on situation. So here they're not spoke much about the how bad is the situation or anything like that. We may go for qualification. So we have to qualify the opinion. In this case, we have to qualify the opinion. We need to explain there is a material uncertainty. There should be adequate disclosure in notes to accounts. There should be adequate disclosure within notes to accounts, and it should clearly explains the material uncertainty, and because of that, assets may not be realized in normal course of business, liability may not be able to pay it. Everything need to be explained in notes to accounts. It is not properly explained, so that's why we are qualifying our opinion. Okay, so guys, it is a material uncertainty which needed a good disclosure, but it is not done. So we are going to qualify the opinion, give that thing in reason. In basis paragraph, we are going to explain this thing. That's it, guys. Very simple. We have repeated this n number of times. A lot of times we have discussed what happens, what kind of reporting happens, and uh, because they're not doing it, we simply going for adverse, guys. Sorry, qualified opinion. So, guys, we are through with 705. Now we go to 706. We look into some concepts of 706, some questions of 710, and then there's no question from 720. There's no question from 720. There's no question from section 143 of Companies Act. It is still there in the course. Okay, we say that the company audit is gone. We say that the company audit is gone, but section 143 is still there in the course. It is still there in the course. And then we go to CARO, lot of cases, and then we are through for the day. Okay, let's see, guys. So first thing there, again, we are taking this only and only because it is there in module audit report versus certificate. So when you give opinion, that document is called audit report. And when you comment on accuracy of the fact, you vouch accuracy of the information, then that document is called certificate. So in one place we have to give opinion, in the other place we have to talk about the accuracy, surety. So that is audit report versus audit certificate. Then you explain, in case of report, there is huge financial information which we check. Here it is very limited. Here a lot of judgment is involved. Here it is not involved. Examination procedures are similar, but here we go for reasonable assurance. Here we go for absolute assurance, and we give examples of both of them. So, and the most important factor is that it is opinion, judgment based. It is facts based on accuracy. That's the big difference. Okay. Now, how key audit matter and EMP are different with each other. Again, guys, don't try to rectify these things. How they both are different from each other, key audit matter and EMP. If you have worked really hard, on any area, then that is a key audit matter. Really hard on some area, that's a key audit matter. Okay, that these were the item of most significant during the course of audit. And if there is something in the financial statement and you want to attract everyone's attention to that, and that's very important for understanding financial statements, okay, then we go for emphasis of matter paragraph. Both are governed by different essays, and if a matter gets eligible for both key audit matter and EMP, key audit matter is going to win. It's not EMP, and there should not be misuse of both of them. Key audit matter or EMP, generally people post their misstatements here so that it doesn't get highlighted, less people pay attention to it. That's not a good practice. Now, let's understand this, guys, what they are doing now here. There's a construction contract. Non-current receivables. So there's a construction contract. These guys do a lot of construction activity and they get in return is cost plus profit. Now they're supposed to take 500 crores from different people. And 500 crores they have to take. This is because of cost overruns, because of change, inflation in price, or changes in the design structure. So we have to take 500 crores. And in some of the receivables, there is a dispute or legal case are going on. But company feels that they are fully recoverable. Okay, fine. So there's a difference of opinion what's going to happen with the debtors. CA Piyush, auditor of the company, has relied upon management representation. So they're simply taking management representation for this, and they're going to put this in emphasis of matter paragraph. Okay, guys, let's understand. Okay. First thing is that in this particular scenario, there's a receivable of 500 crores and there's a doubt over reliability, provision for doubtful debt is required. There's a matter of material misstatement. There is a matter of material misstatement. Okay. There's a matter of material misstatement. That's the one thing. And then that's and he is and so putting EMP for that doesn't make sense. There's a material misstatement. There's a material misstatement you modify. You don't go for EMP. You have to modify the opinion. There's a material misstatement. You have to modify the opinion. Okay. Then you are simply using written representation. That's a misuse of written representation. After doing everything, then we take written representation. Again, that's an issue. That's a matter. So explain that there's a material misstatement. You cannot misuse. You cannot misuse EMP, and we have clearly written the EMP condition that the matter of modification should not come in key audit matter. It should not come in EMP. It should not come in EMP. You're misusing it. Then 580, it cannot reduce, substitute any audit procedure. Again, you are misusing it. So you're misusing EMP, putting modifications into that. You are misusing 580 by simply taking written representation. Okay, guys, let's see. Now, a very simple thing again, very simple, straightforward thing. The first thing is that they're talking about They're talking about that there's a construction activity which was on hold for past few years. Now it's resuming. It's going to have impact. It's going to have impact on plant. It's going to have impact on the business and the operation. Many of the items will come out of obsolescence that may happen. So this is going to have a lot of impact on the overall business. Resume its construction. Resuming its construction is going to have impact on business and financial statements, how they are valued is going to impact everything. So we should put EMP, emphasis of matter paragraph, highlighting this particular fact that people understand it more and better. Okay. So we should resume. So this thing should go in EMP. This thing should go in EMP. On the other hand, the audit report thing, guys, the branch auditors came. So about when we talk about branches, when we talk about branches that so and so branches are not audited, that's the audit related issue. We are supposed to put OMP. Something which improves understanding of financial statements. We go for EMP. That's going to have huge impact on business, impact on financial statements. It's going to improve understanding. Go for EMP. It's when it comes to branches, we always highlight this with the help of OMP, other matter paragraph. If you do something other than the, if you want to focus on audit and audit related things, then it should be OMP. Now, guys, let's see. So here they're saying that everything is always going fine. Suddenly, a new law has come up. It needs licenses. There are restrictions on how business should be done, what type of business should be done, and so on. Now, so there's a big impact. There's a big impact on the business, guys. There's a big impact on the business. There's a big impact on financial statements. Management has given proper disclosure. However, considering the said matter, planning to put OMP, other matter paragraph, that's absolutely wrong. If something is affecting financial statements, it should not be. So explain what is emphasize of matter paragraph, the two conditions, discuss it out, discuss it, and it should have been conclusion, EMP. Putting it in OMP is not in order. Okay. So we are supposed to, so they're doing it wrong. How come something which is affecting business and financial statement is going on OMP? If you want to highlight something which is in the financial statement, you go for EMP. Something outside which is related to audit, then we go for OMP. That's a basic thing, guys. Guys, we're through with 706 also. Just a minute, guys. Just a minute. Just a minute. There's some technical issues going on. Just a minute. Okay, guys, we are back now. 710. We already know what do you mean by comparatives. So we already know what do you mean by comparatives. Prior period information or simply previous year information which is given in financial statement, that is comparatives. Then there are two approaches. Given by two approaches. It is given by applicable financial reporting framework. There are two approaches of presenting comparative information. If a very detailed information is given, very detailed, it is given lot of importance. If last year detailed information is given and lot of importance is given to last year, as if it is a separate financial statement, it is so much detailed, it is having separate accounting policies altogether, it is having separate accounting policies, significant accounting policies, separate notes to accounts, all lot of information is given. It is a separate financial statement in itself. In intro and opinion, we refer current year as well as previous year, because you are giving so much of detailed information about the previous year, so much of importance in itself. It is separate financial statements. Keeping in point all these things, okay, all these things, we are saying that we are going to give opinion on current year as well as previous year. This is called comparative financial statement approach. If no detailed information is given and it's not given lot of importance, very limited information is given just for comparison, it is just for comparison, no detail, it is not a separate financial statement. In fact, it is a small portion of the current year financial statement. It is an integral portion of current year financial statements. Then in intro and opinion, we refer only current year. That is called corresponding figures approach. Corresponding figures approach is the most famous approach, guys. Corresponding figures approach is a very famous, is a very famous approach, very famous approach, corresponding figures approach. Okay, and it's very popular one. Now the question is, how are you going to do audit of comparatives? So they are going to ask, how will you do audit of comparatives, or they are going to ask one, how are you going to do audit of comparatives, or next they will be asking how you are going to do audit of corresponding figures, or they are going to ask how you are going to do audit of comparative financial statements. So if question is asked like this, answer is same in all the three cases. In all the three cases and scenarios, okay, it is going to be same audit procedures. Let's see. (701.040). Let's see, guys. So what are the audit procedures? What are the audit procedures for this? So what we have divided in three parts: basic audit procedures, additional audit procedures, and simply written representation. So guys, it is divided into three parts, three simple things we are supposed to do. First is basic audit procedure. We will go and read applicable financial reporting framework and we'll try to understand what information is required with respect to comparative information, and we are supposed to check whether that information is given as per applicable financial reporting framework. So we'll understand financial reporting framework and check whether information is given as per applicable financial reporting framework. Then next is to check it further. What we are going to do is we are going to match whatever comparative information is there as per applicable framework with the previous year ledger and previous year financial statements. We are simply going to agree with previous year books of accounts, previous year financial statements. Then we'll also read accounting policies, because the two columns are there, current year and previous year. They are next to each other, they are compared a lot. So a same basis should be used for preparation. So we go and read accounting policies for previous year, current year, we compare them, we understand whether there is a change, we do inquiry. If there is a change, okay, whether change is justified, it's properly accounted for, presented and disclosed. So we go and focus on framework, we go and match things with previous year, we go for change, we go and evaluate accounting policies. Additional procedure. If there's a possible material misstatement, actual material misstatement, we perform additional audit procedure. Then we perform anything we want to perform. We can go for previous year records, previous year recomputation, reperformance, previous year reperformances, documentary evidences. We can go for anything we want, previous year ratio analysis. If there's a possible material misstatement, we go perform additional procedures. Additional audit procedures will be performed. Now, if we come across material misstatement, we'll ask for the rectification. We'll ask if there's a material misstatement. Then, if depending on whether we came to know before signing audit report or after signing audit report, as per SA 560, it will be dealt with. We'll ask for rectification and it will be dealt as per SA 560. So, additional audit procedures and rectification. We go for written representation. We want for all the number of years, for all the number of years which are disclosed. Okay, for all the number of years, for all the number of years which are disclosed in disclosed in financial statements. Okay, we need written representation. If you are going to specify 2 years written representation and so on. So we have basic audit procedures focusing on framework, focusing on matching with previous year, focusing on accounting policy. If required, we have additional audit procedures and written representation, guys. Now, guys, so this is the audit procedure you're supposed to talk about. Basic evaluation, additional procedures and written representation. Next, now is a very famous question. So there was a time 2018 it got very famous. It came in May 18 mock paper, then it came in May 18 exams, then November 18 exams. So there was a complete flow. Now again they have introduced it in May 23 mock paper. They've introduced it in May 23 mock paper, guys. Okay. Let's understand this. But before we go to that, we need to understand a very simple concept first. Okay, a very simple concept. Okay, let's understand this, guys. So if problem is silent, first of all, we assume that if problem is silent, we assume that it is going to be corresponding figures approach, because that's the most popular approach. We always assume that there's a corresponding figures approach because that's the very popular approach, corresponding figures approach. Okay. Now, what we are supposed to do, let's say this is, guys. Now, generally we don't refer to, in corresponding figures approach, we give opinion only on the current year. We don't refer to the previous year. We don't give any kind of reference to corresponding figures. We don't give any kind of reference to corresponding figures. Okay, we never talk about them. But then there are exceptions. If there are exceptions, guys, if previous year's audit report is modified, prior period we are having modified opinion. Or while doing current year audit, we came across material misstatement in the previous year. It's very simple, guys. We generally don't refer to previous year at all in corresponding figure approach. But if there is a modified opinion there's a modified opinion for previous year, or we came across material misstatement in previous year. In both the cases, that means there is a problem with previous year. What we do? We go and request management. Listen, management, there's a problem with previous year, as evident from the audit report, or we came across it during current year. There's a problem with the previous year. We request it to please resolve it, please rectify it, please resolve the issue, please resolve the matter. If they resolve it, it's well and good, no need to do anything else. But if they don't resolve it, we'll have to modify our audit report. We have to say that we have to modify our audit report. We have to explain people what's wrong with the financial statements. If it is affecting both the years, there are some misstatements which affect both the years. For example, depreciation is not charged. Depreciation is not charged in the previous year. So it's going to affect previous year and current year. Current year WDV is going to go wrong. WDV is going to go wrong. And if WDV is going to go wrong, if WDV is going to go wrong, guys, okay, then in that case, it is going to have impact on the current year also. It is going to have impact on the current year also. It is affecting both the years. And then there can be some misstatements affect only previous year. For example, lottery income was posted in sales. Lottery income was posted in sales, so it's having impact on the previous year only, and not at all in the current year. Okay. So we are going to describe that there's an effect only on the previous year, but because of that, comparison of the previous year and the current year is going wrong, and that's why we want to highlight this thing to everyone. We are modifying our opinion that comparability is going wrong. There's a problem with previous year, and comparability of previous year and current year is going wrong because it is having lottery income in it. In the current year, there is no such lottery income. Now, the way they have asked it is, they say that no provision was made, report is modified. They say that there is a qualification. They say that there is a qualification. Previous year is qualified, and no provision for taxation was made in the previous year. And in current year, what will happen in two scenarios? If they don't make provision in the current year, that means the issue is affecting previous year as well as current year. And next, what if it is rectified in the current year? That means it is affecting only previous year and not the current year. So in this particular case, guys, they said there's a problem with the previous year, and situation 1, same may continue. Situation 2, same may not continue. So you're going to explain all of these, and then we are going to say, in first situation, there's a problem with previous year as well as current year. So we'll modify the opinion for respect to both the years and say that there's a problem. There's a problem with the financial statements. There's a modification. If there's a problem only with the previous year, we simply say that there's a problem with previous year. It has no impact on the current year. We are modifying only with respect to previous year. And we want to tell everyone that comparison is going wrong. Comparison is going wrong. So you need to give reference of SA 110, you need to explain the situation, you need to explain, sometimes you have to refer to both the years, sometimes you have to refer to only current, only previous year, and explain then the point of comparison. And you need to discuss the case and what to be done in those. In first case, we'll say both are misstated. In second, we are going to say only previous year is misstated. They ask this question again. Now, instead of provision for tax, they asked it in a way of provision for diminution in value of investment. Provision in diminution of value of valuation, diminution in value of investment. The way they asked it changed. The way they asked it, the previous they were talking about provision for, previously they were talking about provision for doubtful debts, and now they are talking about provision for diminution in value of investments. Okay. Now, the very interesting way of asking the question again. This time they said that one more way. They're saying that they didn't charge depreciation of 2.5 crores. 2.5 crores was charged to P&L, but that 2.5 crores should have been charged to carrying value of the asset under construction. So there's a material misstatement. material misstatement in the previous year, and the book value of the asset is going wrong, and because of that it is going to have impact on the current year also. It is going to have impact on the current year. Again, you explain the theory, and then you say that because it's going to have impact on both the years, we are going to modify with respect to both the years. Otherwise, we would have modified only for the previous year and explain that only comparison is going wrong. Okay. So guys, it has been a very famous question earlier. 720, there is no question. There is no question from 720. Then from section 143, there are some. Remember, guys, company audit is not fully gone. Section 143 is still in your course. CARO is still there in your course. Now, there are a lot of questions of CARO. Let's discuss very small ones. So, in totality, we will be covering around 44 questions today. Okay. So this is the question. Very simple question. Company is planning to sell their land and building, to sell their property. They sell their property. They're looking for a suitable buyer. But the point is, they have property. It's there in your possession. They have paid full amount when they purchased it. But because of some procedural deficiency, it is still not in the name of the company. It is still not in their name. Okay. And they have not registered anything about it in notes to accounts. They have not made any disclosure in notes to accounts. Okay. So what are we supposed to do? Okay. Now, guys, so CARO is applicable. So now they have written CARO 2020 at the start. If they would not have written CARO 2020, the question would have become very interesting, because you have to interpret and then apply things there. So you're going to say, okay, clause number 1 of the CARO is applicable. It deals with fixed asset, and it says that if this is a land and building, immovable property, and it is not yet in the name of the company, the title document is not yet in the name of the company, then details need to be given. And to explain what is the nature of the property, land and building, what is their gross amount, tell us on whose name it is right now, whether that person is a director or some related party, from how many years this is there, whether there is any dispute going on. So these details need to be given. So these details need to be given in CARO report. So do remember, guys, whenever there's a problem with the title document, you should always recall CARO. So generally students recall it. That's not a big question. That's not a big problem. The next, very interesting. And again, they have made two observations. Question 392.200. There are two observations. Now, what are two observations, guys? What are these two observations? They are very simple. They are very simple two observations. First, they have revalued their plant and they have made revaluation. Okay. So if they had taken asset on lease and it was revalued by registered valuer, and valuation has gone up from 4 crores to 4.5 crores, 4.45 crores. Comment. So now you should recall and remember that, okay, in fixed asset, there's one more point. There we need to explain, number one, whether there was revaluation during the year. Whether there was revaluation. Next, we are supposed to explain whether this revaluation was done was done by a registered valuer. Whether it was done with registered valuer. Okay. And then next, if there is a change, and if change is more than 10%, if there is a change, if there is a change and change is more than 10%. If the change is more than 10%, guys, okay, then we need to quantify it. We need to explain 10% or more. If the change is 10% or more, we need to give details that okay, this is it. So you need to remember that okay, there is such thing. So we need to give report. Yes, there's a revaluation. Yes, it's done by registered valuer. Yes, there's a change is 10% or more. Yes, so there's a change of 10% or more. And what is the amount of change? You have to give amount of change only when the change is 10% or more. So you explain that there's a change of 0.45 crores and that is 45 lakhs. So if you remember that there is such clause and these are the three requirements, then you will be able to answer it properly. There's a big chance that some students will miss out about this change of 10%. Some students will miss out the change of 10%. Then if we talk about the next is, there's a lovely, again, very lovely. There's a cash credit limit of 5.5 crores was sanctioned. You know that there is a CC limit. You know that there can be CC limit. There can be CC limit, cash credit limit. Okay, and in that CC limit, CC limit, there's a CC limit, and you know that initially the limit which is sanctioned is a CC limit. Then company sends more information, quarterly basis they send information of debtors and stock and creditors. Then they compute drawing limit. So drawing limit has come down to 4.5 crores. 4.5 crores, it has come down to 4.5 crores. And now they are further saying that the whatever information they send to bank, it is in line, it agrees with books of accounts. So you need to remember, okay, there is clause number 2, it deals with inventory. There are two parts. First one talks about reasonable, whether inventory is physical verification is done within reasonable interval of time, where is done within reasonable interval of time. That's a part 1. This is a part 1. And then we have part 2. And then we have part 2 which says that if there is a sanction limit of 5 crores, of more than 5 crores, in excess of 5, sanction limit excess of 5 crores, nothing to do with the drawing limit, we need to tell whether the information sent to the bank and information books of accounts, whether it agrees with each other. In fact, the same thing needs to be disclosed in Schedule 3 in notes to account also. But they're simply talking from the CARO point of view. But then you should know the same thing needs to be disclosed in notes to account also, whether the information is sent to bank, whether it agrees with books of accounts. And there is no credit limit concept in Schedule 3. Okay, let's freeze, guys. As per Schedule 3, we are supposed to explain whatever information was sent to bank about the current assets, whether that information matches with the books of accounts as per Schedule 3 needs to be given. That is one thing. As per CARO, if the sanction limit, not drawing limit, so some students may get confused. We have to just look at the sanction limit. We don't have to look at the drawing power, not for the drawing power. If that is X of 5 crores, we need to comment whether the information agree with each other, whatever information quarterly it is sent. So you say yes, this clause is applicable, and we will say that they agree with each other. There is no issue, no problem at all. So important thing is drawing power is not at all important. Very interesting one. For those who know CARO also well and Schedule 3 also well, they will be able to immediately apply. Okay, Schedule 3 is also applicable and CARO is also applicable. Now here they say that only 50% of the inventory was covered under physical verification. Rest 50% will be covered in next year. So we know that Clause 2, physical verification should happen within reasonable interval of time. Physical verification. Physical verification should happen within reasonable interval of time. Okay. Now, it should happen it should happen within a reasonable interval of time. And reasonable interval of time, they say that it should happen at least once in a year. So physical verification should happen of the inventory at least once in a year. Here they are saying only 50% is verified in the current year and 50 next year. That means the whole inventory is physically is verified once in 2 years. It is definitely not reasonable interval of time. It is definitely not reasonable interval of time. So we are going to repeat, we are going to say that no, 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 no. This is not at all, reasonable interval of time. This is not at all reasonable interval of time. We were this is not expected. Okay. When we talk about fixed assets, in fixed asset the reasonable of interval of time can go up to 3 years in case of fixed asset, but that's not the case in case of inventory. Then again, a beautiful case that a case is pending, litigation is pending, income tax litigation is pending in front of ITAT, and there is a demand of 65 lakhs of customs demand notice. No action is taken, either for paying or going against the order, demand notice. So you should immediately recollect statutory dues. Clause number 7. You should immediately recollect clause number 7, statutory dues. First is they talk about undisputed items. If they are undisputed item, we are supposed to comment two things. Are they regular in paying statutory dues, and whether there is any due which is outstanding for more than 6 months. So when it talks about custom duty, see, we have to comment on regularity if there are periodical payments. That means monthly payments, like TDS is a monthly payment, GST is a monthly or quarterly payment. So the PF is a monthly payment. These are monthly payment, guys. So we talk about regularity. In case of customs duty, we are not supposed to talk about regularity. Now, whether any amount is outstanding more than 6 months, answer is yes. This was due on 15th of September, October, November, December, Jan, Feb, March. As on 31st of March, it is more than 6 month amount is outstanding. This will be reported for sure. So now next is disputed. So this will be reported in undisputed category, and next will be in disputed category. If they are disputed and amount is not paid, we need to give full details. That so and so act, there's a dispute, so and so amount, so and so authority from so and so year. So that information, so it should be there. And one more thing. So whenever you see this clause, statutory dues, and you see that there's a non-compliance, there are allegations, there's a non-compliance, like there's a dispute, so there's allegation, there's a non-compliance of law. You need to apply as a 250. Explain in short, it's management responsibility to ensure compliance of all laws, rules and regulations. As an auditor, if we come across any non-compliance, we go and obtain information, we discuss, we understand the effect on financial statements, we understand what can be the impact on financial statements, and we ask management to do those adjustments. If not, we'll have to modify the opinion. So explain in short, management responsibility, the auditor responsibility, because of inherent limitations, very difficult to catch hold of non-compliances. So I need to explain that. So when now you remember, if there is statutory due and if there is any kind of non-compliance, suspected non-compliance, you refer 250 also. So in this case, they're saying PF not deposited. If PF is not deposited, it will be reported they're not regular in paying provident fund. But then they're saying that they are going to pay in full along with interest. See, you're not paying on time, there's a default. It will be reported, irrespective of whether you repay everything at the end of the month, at the end of the year, or after financial statement, before finalization. It doesn't matter at all. If you are irregular, you are irregular. It has to be reported. How you rectified the situation, we will specify this. Yeah, it's regular, but it was rectified end of the year. Or after that, we'll explain that. But till that time, that default should be explained. That default should be explained. Default in repayment of loan. Again, there's a default, but everything was settled before financial statement were finalized. Doesn't make. If there's a default again, guys, very important. If there's a default in loan repayment, it should be explained in Schedule 3 also, and it should be explained in CARO. So company will explain this in Schedule 3 and give details that this is the loan, this is the default, interest, principal for so many years, so many installment, and so on. So disclosure is required by Schedule 3 also, and disclosure, and as an auditor, we are supposed to write it in CARO report also. So you have to write there is a default. At the end, you explain that everything was paid off, but it needs to be explained. So draft report at the end, you may explain that the outstanding amount was settled after year end before financial statement was finalized, but you have to explain that there was a default. So this is the case asked in November 22. So they made and this is a very simple thing, very simple thing. They're talking about reschedulement. They are talking about reschedulement. So they say that there is a loan involved, everything was going fine, but then their default happened. When default happened, company went to bank and they rescheduled the loan. If default happened, it should be reported. If it's rescheduled, that's great thing. That will be written afterwards in one line that issue was resolved by rescheduling. But that has to be reported. That's important. And secondly, it is so as per Schedule 3 that is required. As per Schedule 3, they have not provided anything in notes to accounts. So they have not, it's a complete non-compliance of applicable framework, non-compliance of Schedule 3. You have to modify the opinion. Such an important disclosure is not given. In audit report, we are going to give disclosure. We are going to write that that loan, there was a default and later on it was rescheduled. So just be careful about it. Default should be reported. Even if you repay everything, default should be reported. Even if there is a reschedulement, default should be reported. Money raised, misapplied, that's very famous. If you misapply money, if usage is not proper, you took money for R&D and you took CAR out of it, that needs to be reported. Okay, related party transaction. So they are saying that there's a related party transaction, so many lakhs are paid per month, and it's not an arm's length price. Okay, so there's no arm's length price. It is an overpayment. So you'll explain what as per CARO. As per CARO, we are supposed to report on two things. Whether there is a compliance of section 177 and 188, and whether there is a proper disclosure in notes to accounts as per AS 18 and as per corresponding Ind AS, whether there is a proper disclosure out there. Ind AS 24, whether proper disclosure is there. So first thing, now here they are saying that there is a payment to related party and it's not arm's length and no separate disclosure is given. So we are going to explain, number one, that before any related party transaction happens, approvals are required under 177 and 188. If any transaction is not at arm's length, approval from board of directors is required under 188. In this question, there is no information about the approval. That means they have not taken proper approval. That means they have not taken proper approval under 188. So it will be reported here that no proper approval is taken for transaction which is not at arm's length. It is not at fair value. It is not proper. So it has to be reported here. It has to be reported here in first thing. And then there is no proper disclosure as per AS in India's 24. Then again it has to be reported. There is no proper disclosure. So in CARO, we are going to adverse reporting. Always remember, if you come across that even the financial statements are not properly prepared, like there is no proper disclosure, we'll have to additionally modify our opinion. We'll have to qualify that notes to accounts are not proper because related party disclosure is not given. So reporting in CARO is one thing and modifying the opinion is another thing. We'll have to modify the opinion also. Okay, so there's a problem with compliance also, and there's a problem with compliance also, and there's a problem with disclosure also. So in CARO also you are going to report and you're going to give opinion on financial statement. There also you're going to report. Then director's son is doing non-cash transaction. Non-cash transaction is pretty simple, straightforward. It's a barter transaction. Non-cash transaction is pretty simple, straightforward. It's a non-cash transaction. It's a non-cash transaction. It is simply barter, taking one plot and giving another plot. So if there's a non-cash transaction with director or its connected people, then 192 is applicable. 192 says that if director wants to do non-cash transaction with company, then prior approval of shareholders will be required. And then if the director is of holding company, prior approval by shareholders, ordinary resolution will be required in that company where transaction is taking place and also in the holding company. Okay. So here there is no such information. That means they have not taken any approval of 192. We'll have to report that there is a complete non-compliance of section 192 when directed or connected people do barter transactions. We have to report under clause 15. So we have to report whether non-cash transaction. If yes, then we have to explain it is not as per Companies Act. It is not as per section 192. Okay. Then here, what reporting we have to do with respect to NBFC? It's very simple. First, we have to see whether certificate of registration is required for the NBFC. Is it required? We have to comment that. If it is required, are they having proper certificate of registration? If not, whether any transaction was done without certificate of registration. We are supposed to report three things. First, whether NBFC registration is required. Next, is it taken? And next, whether any transaction is done without any approval. Okay. Now they are asking what should be the audit procedures to check this. Audit procedure. So we are supposed to check whether it is required, NBFC registration is required for so and so company. We should go and understand nature of the transaction, examine what is the nature of transaction, whether they are into financing activity. If yes, next we have to see whether more than 50% of the income is financial, more than 50% of the asset is financial. Yes, then it's a proper NBFC company. They need certificate of registration. They need net own funds of minimum 2 crores. Depending on category, it will change. And then we talk about whether they have taken proper registration. from NBFC, and then their transactions, whether any transaction was done without registration. So guys, we have to report on few things, 3 things we have to report, and simply we are going to check that. We are going to see transactions. Okay, whether they are transactions, whether any financing transaction, whether any transaction on which NBFC, RBI Act or rules regulation applicable. Is it so keeping in mind the clauses, we are supposed to first tell whether it's required. So we are supposed to see the nature of transaction and see 50-50% rule. Okay, then if it is required, they have taken, we have to say no, they are in process of taking, they have applied or they have not taken. And thirdly, then we are supposed to in NBFC whether any activity was done. So simply on these 3 things, you go and describe the audit procedures. Go and describe the audit procedures. Very simple, straightforward. First, you see the nature, then 50-50 rule, then net own funds, and when the registration is taken. Very simple May 23 case study, guys. Very simple, straightforward May 23 case study. Now, what is that? There's an authorized share capital of 200 lakhs. That's not relevant for us because we need paid up capital. Paid up capital is of 95 lakhs within the limit. That's great. They may get the exemption. 15 December, they had loan of 75 lakhs. They received 30 lakhs more, and within 2 days they repaid. So point is, in borrowing, we have to see whether any time during the year it crosses 1 crore. In this, even though they have paid within 2 days, it has crossed 1 crore during the year, condition is breached, they will not get exemption from CARO. Now there is a Benami property case proceeding going on against them. So now you are supposed to explain, as per Schedule 3, in notes to accounts, the company is supposed to explain if any Benami Property Act is going on. Even if legal team says that it's absolutely fine if you are going to win the case. There's no issue with, no problem with that. But as per Schedule 3, it has to be disclosed. Benami property case has to be disclosed as per Schedule 3. Irrespective of whether we're going to win or lose. And CARO also, we have to do reporting if there's a Benami property case going on. So they will have to report in books of financial statement, we have to report in audit report. If these things are not okay, if they don't disclose it properly, we'll have to modify the OPIN also. CARO reporting is one thing, always ask whether we have to modify the OPIN also. Cash loss of 39 lakhs, we have to say whether in current year and previous there was a cash loss. If there is cash loss, we say okay, 39 lakhs cash loss. Auditor offered to resign but then didn't resign. Clause gets applicable when auditor resigns. After resignation, whether the incoming auditor, they read the complete thing properly before going ahead. That was supposed to write, whether if the person is resigned, but then only offered to resign. So nothing applicable, no reporting. They talk about applicability, they talk about Benami property, they talk about cash loss, they talk about auditor resignation. Guys, last question and clause number 21. Clause number 21. Let's understand this, guys. Clause number 21 is now very simple, consolidated financial statement. CARO is not applicable to audit report of consolidated financial statements. It's not applicable. It is not applicable, not at all applicable to them. Okay. Except there's an exception, clause number 21 is applicable. Clause number 21 is applicable. First 20 clauses are for standalone financial statement. Is for standalone financial statement, and the last one is about consolidated financial statement. It is about consolidated. It is about consolidated financial statement, guys. Okay. So you talk about applicability, yeah. So in standalone, audit report of standalone, you will find 20 clauses. An audit report of consolidated financial statement, you will find only one clause. Only one clause will be there. Okay. So in this, what happens in this one clause? Simple. For all the company, for all the entities which are consolidated, for all the entities which are consolidated in the financial statements, which are consolidated, which are consolidated in financial statements, we have to report whether their CARO report, any of the clauses, there was an adverse remark. And we have to give the table that so and so company, its subsidiary, associate, joint venture, or holding company, these are the companies which were consolidated, and these are having the adverse, clause number 2, clause number 3, clause number 4, we are having adverse. So a simple table, first column, name of the company, second column, relation in a group, status in the group, and the next column, clause numbers where adverse remarks were made in CARO report. Okay. So CARO applicability is not applicable to console. Clause number 21 is applicable. Conclusion. Guys, tomorrow's session, next sessions are going to be important to attend positively. Put your lovely comments. They matter a lot to us. Do put your comments, guys. And tomorrow we'll be having class on regular 8 o'clock. We'll be having our morning 8 o'clock. We will be having our class.